Hi, I'm Jimmy Lepping, psychologist and statistician, and in this video I study cross-correlation functions of monthly percentage changes in gold price, copper price, gold-copper ratio, the S&P 500 and the Dutch AEX large cap index. To study these relations, I have taken the monthly closing prices of each of these five subjects all the way from January 2001 until the October close of this year, 2023. And before we dive into the cross-correlation functions, I show the lag zero correlation networks here. Lag zero means that we are correlating percentage changes of the same months in different subjects. Here we see two networks, one with the two stock indices and the two metals, gold and copper, and the other network with the two stock indices and instead of the two metals, the gold to copper ratio. The nodes represent the different subjects in each network, whereas the lines represent correlations, with lines in blue indicating positive correlations, lines in red indicating negative correlations, and thicker lines representing stronger correlations than thinner lines. So in a nutshell, we see that the two stock indices have a relatively strong positive correlation, meaning that relatively better weeks in one index tend to go together with relatively better weeks in the other index, and both indices also tend to share relatively weaker weeks. In addition, we see that copper is modestly positively correlated with the stock indices, which makes sense because in times of elevated economic activity, we tend to see an increased demand in copper, which is an essential industrial metal, and also increased stock prices. And gold's correlation with stocks is near zero, and the gold to copper ratio is negatively correlated with the stock indices. So let's dive a bit deeper into these correlations by studying different cross-correlation functions. Here is the cross-correlation function of gold versus copper, in which on the horizontal axis we see lags, which indicate the number of months of difference in time between moves in one subject and moves in the other subject. And in this function, which is gold versus copper, negative lags indicate that changes in gold are a leading indicator for changes in copper, whereas positive lags indicate that changes in copper are a leading indicator for changes in gold. This is not to state a causal relation, simply that empirically moves in one tend to precede moves in the other whenever we find a substantial correlation at a lag other than lag zero, because lag zero represents changes in the same month. And in this function, the only correlation that stands out a little bit is that at lag zero, which is just under 0.3, which is really only a modestly positive correlation and indicates that less than 9% of the variation in one variation in changes in one subject can be explained by changes in the other subject in that month, which is not a lot. And here is the cross-correlation function of gold versus the S&P 500, where we see no substantial correlations. The only correlation that stands out a tiny bit is at lag -9, which is nearly 0.2 negative and hence a relatively weak negative correlation, which indicates that changes in gold prices in a given month weakly predict changes in the S&P 500 in the other direction 9 months later. But again, this correlation is weak. Squaring this number, we would not get even at 4% of variation explained, just to give an idea. A similar picture we encounter for gold versus the AEX, with the correlation at lag -9, this time being only just slightly stronger than -0.2, but still not an awful lot. Here we see copper versus the S&P 500, where for the lag zero correlation we find about 0.47, and for that tiny second peak at lag -2, which is barely visible, we find only about 0.16. So above all, a positive correlation at lag zero, indicating that we can explain about 22% of the variation in changes in subject in one subject by changes in the other subject in that month. In this scatter plot, we see what that lag zero correlation of about 0.47 looks like, a decent positive correlation. And even when we split the data into 3 time blocks or 3 blocks of different periods of years, we see a consistent positive relation between these two subjects at lag 0. And we see a similar picture for the cross-correlation function of copper versus the AEX, similar to what we just saw for copper and S&P 500, this time with the lag 0 correlation being just under 0.4, but still moderate. And then already in the first chart of this video, we noticed a relatively strong positive correlation between changes in the S&P 500 and changes in the AEX. And this is what we see visualized here. We are talking about a correlation just over 0.8, which is strong and indicates that we explain a bit over 64% of the variation in changes in one subject by variation in changes in the other subject in that month. Here we have a scatter plot to visualize that positive correlation of just over 0.8 and lag 0 lag 0 between the two stock indices. And even when we split the data into 3 time blocks, we see a consistent positive relation. Next, the gold to copper ratio versus the S&P 500, where we see, not surprisingly, a moderate negative correlation of nearly minus 0.45, indicating that we can explain about 20% of the variation in changes in one subject by the variation in changes in the other subject in that month. And here a scatter plot of what that negative correlation of nearly minus 0.45 looks like. And split out over the 3 time blocks, we consistently find such a negative relation at lag 0 between these two subjects. Also, not surprisingly, the cross-correlation function for the gold to copper ratio and the AEX is similar to what we just saw for the gold to copper ratio versus the S&P 500, with the lag 0 correlation this time being about minus 0.42. So to conclude, we do not find any signs for an ability of changes in gold or copper prices to predict future changes in stock prices. The best that we find is covariation in the same month at lag 0, with gold not really being correlated with stocks there, but copper having moderate positive correlations with stock indices, and the gold to copper ratio having moderate negative correlations with stock indices. If we were to take the copper to gold ratio instead of the gold to copper ratio, which is what some people tend to do, the correlations with stocks would of course be moderately positive instead of moderately negative. After all, in times of economic expansion, we tend to see higher stock prices as well as an increased copper demand and thus higher copper price. Whereas in times of economic contraction, we tend to see lower stock prices as well as a decreased copper demand and thus lower copper price. Yet at the same time, in such periods of economic contraction, we tend to see higher gold prices because gold is considered a safe haven in economically less favorable times. Okay, that's it for this video. I hope this is useful. If you have any ideas or suggestions for future videos, you can leave a comment below this video or just drop an email at lappinkanalytics@gmail.com. Have a good day and see you soon.